Qualcomm stock is down about 10% in the last week. Today, I'm going to be talking about why Qualcomm is being allocated with around 8% of my total funds here in my portfolio. Let's get into it. It's down around 32% since all-time high from around June 2024 last year. At one point, it was down more than 40% since all-time high. That would have been a great buy, but it's only up 15% since the bottom. So I think it's a good opportunity to still pile into this stock. But last bear market of this stock was almost 44% here, and it started in January 2022, lasted until October 2023. So 1.5 years or so of pain and swings, and not so much pain, because the stock was paying a pretty fat dividend. It's sitting at around 2.4% right now, but back then, and I guess with the lower price, it was paying around 3%, so it was great for you if you held it. And very quickly, it spiked for more than 100% in price. So late October 2023 until early 2024, we're looking at more than a double in total market cap, which is kind of crazy, to be honest. So that's the cyclicality of the semiconductor industry. You need to get used to it. There will be brutal swings, and if you don't catch these stocks at a good price, I mean, you're just gonna miss the rally and you're gonna be left behind. So I wanted to show you here first. Before the dot-com bubble, the stock was trading at a few $1 billion, which back then it wasn't so low for a semiconductor company pre-2000 to be trading at a few $1 billion. That's quite something. I mean, only Intel and AMD and some others were trading at a few $1 billion. Intel, I guess, got to a high of 500 billion in the dot-com bubble, but this Qualcomm stock got up to around 125, and today it's trading at 158. So trust me when I tell you that Qualcomm had a very long time to grow into that valuation. If someone told you, yeah, 25 years from now, you're going to be buying this at a $158 billion after inflation. So if you take inflation into account, I think it has to be trading at a lower level. I mean, it's 25 years worth of inflation. But anyway, let's just take a look at some other levels. 2014, it had a high of 135 billion and a low of 60 billion in 2019, which is kind of crazy. Imagine buying this for $60 billion. Yeah. 2021, before the crash started, it was around 200 and something billion, and the last high was at 240 billion. So it's missing around 80 billion from the market cap. Let's get into the numbers. PE ratio 14, for PE 12, dividend yield 2.4%. Keep that in mind. Let's take a look at the revenue and the cyclicality of it. Does it have brutal swings like Micron or some other type of semiconductor companies? It doesn't seem like it. It seems like it got a big increase in 2020, and it's kind of held it since then and slightly growing it. Yeah. Let's take a look at net income. 10 years ago was hovering around 5 billion, 5.7, 2.4, and a minus of 5 billion 2018. A high of 13 billion 2022. So as you can see, the swings are pretty brutal here. It doesn't just go up in a straight line, or when things slow down, they're not flatlining, they just go down by a lot. Okay, net income goes down by a lot. So you kind of need a competent management to deal with these swings. You cannot have people making huge mistakes, such as buying back too many shares like Intel did. Intel had a very, very bad management, and look where it got the company at. Shares outstanding going down over time, and going down by a lot in 2018. They did a massive buyback of around $20 billion. And remember, in 2019, the market cap got to a low of 60 billion, which was completely ridiculous. I mean, imagine owning a company, a tech stock, not just a tech stock, a semiconductor stock, and not just a semiconductor stock, a fabless design semiconductor stock, trading at $60 billion and the company being able to buy back almost $20 billion. I'm going to show you in a moment. But yeah, it's good to know that whenever the company feels like their shares are extremely undervalued, they can just say, okay, we're just gonna retract a huge percentage of our shares outstanding from the market because the valuation is getting ridiculous. And as you can see here, minus 16% and then minus 5%. So we're talking about 22, 23% if we take into account 2018 as well. I mean, let's just say 25% of the total market cap, of the total shares outstanding, not market cap, were retracted in a short span of 3 years. So that's great news to see. For me as a holder, whenever I'm buying something that's gone down, not as a margin of safety, it just makes me understand better where the floor of the price is. Lets me know that, okay, this management, they are willing to step in big if the share price drops by a lot. So, like I said, here, this was a very good opportunity to buy whenever, yeah, the price went down by a lot, went down to 124, April 2025 here. And the total swing was about a third in market cap. This was a great time to buy. But I don't think this is I don't think you have missed the train completely. I'm actually looking to maybe add some more to my position, but we'll see. Let's look at the margins real quick. Gross margins 10 years ago was at 60%. Now it's at 55. A high of 64% 2019. I don't see anything wrong with this. Yeah, sometimes it gets really high, but I think the average is quite it doesn't move a lot. It does go up and down, but not by a lot, and I think the average is like 57% or so. So we're at 55 right now. Operating margin, now this does change quite a bit. A low of 16 to a high of 33. So more than double in just 1 year. So you can see the swings are quite brutal in margin levels, but this is what creates a huge opportunity in the market. I mean, just take a look at the market cap here. 135 billion going down to 60 billion. So less than half. This is exactly what I want to see. Huge opportunities for me to buy and to make a lot of money. Because if the stock goes down by 50%, I'm going to be making 100% on my money when it does recover. And a fast-growing company like Qualcomm, being in the tech sector, technology sector, in the semiconductor industry, in the fabless design industry, it's going to eventually recover. It's not going to take long. Maybe a few years, like you saw here. It went down for a few years. Let's just say 5 years. It went down and down and down, and then it recovered very quick. So when it does recover, it moves very fast. As you can see, the upswings here are very fast. So you have a lot of time to buy, but if you missed it, you're going to be scratching your eyes, to be honest, because you're probably not going to get another opportunity to make money on the stock very soon. So it's just going to trade sideways, and you're just going to waste a lot of time underperforming the market with that capital allocation. So that's not good. Just buying and holding. I mean, if we take a look at this stock, it's up 34% over the last 5 years. And if we compare it to the S&P 500, this has been underperforming quite a lot. But if you had bought low, let's say if you bought around here, September, May 2023 until September, October 2023, you could have massively outperformed the market. So that's exactly what I'm trying to do. I buy low and I sell high. That's the only sure thing when it comes to outperforming the market. Whenever you're buying high, that's a lot of risk and extremely low chances of outperforming. Actually, you are most likely to underperform. Just look at the tops here. All the people who bought at the top and held it are now massively have not massively underperformed the S&P 500, which is in itself a disaster when it comes to investing, because you could have just bought the index and held and reinvested the dividends and you would be fine. So whenever I'm trying to invest outside the S&P, I'm trying to take a lot of a huge margin of safety and I'm trying to have a high probability of outperforming the market. I'm very careful where I put my money. I usually try to stay away from stuff that has gone up a lot in a short period of time. That's where you can lose a lot of money. But anyway, cash and cash equivalents, 2017, like I said, they got a lot of cash on their hands in around this period, and then they made a significant buyback. As you can see here, cash flow, repurchase of common stock, 2018, almost $23 billion. That's insane, dude. That is crazy, because the market cap in 2018, let's look by quarterly. I mean, look at this. 95, 79, 86. What are we talking about? I mean, you can see where they probably started buying back shares, and the price gone down as well. That's just crazy. The price has gone down by a lot in 2018, while they were pouring $23 billion into the share buybacks. I mean, that's crazy. You could have bought this at extreme dirt cheap prices. But anyway, let's continue with the balance sheet. What do they have now on hand? Around $5 billion. Not a lot, not the lowest they've had. Total current assets, because they had a lot of cash on hand, 2017. I would basically ignore this part and just look at the trend since then, since 2020, I guess. Trending up, that's good to know. Total assets, trending up with a small dip right now. And I want to take a look at total shareholder equity. So keep in mind, this is a fabless semiconductor stock, so I don't care about having a lot of equity in the firm. They're not going to have a lot of debt either. They have no reason to take on a lot of debt unless they buy some other company or something like that. So they had net cash. They have had 20 billion of net cash for a long time, until they decided, okay, we're going to burn through our cash and we're going to buy back shares because it's getting ridiculous. And they did go into debt a little bit, and they have been they have been paying down their debt since then. A high of $10 billion of negative net cash, and around zero first quarter of 2025. So yeah, I mean, this company is not at any risk of going bankrupt anytime soon. I mean, when I say anytime soon, anytime in the next 15 years, 20 years, yeah, I mean, it's still growing revenue and it has beautiful prospects about their future. Let's take a look at net income per year by year, and then compared to the stock-based compensation. We already took a look at when we first started to see the numbers. But yeah, last year, $10 billion. This trailing 12 months, $11.5 billion. Stock-based compensation, it does go up by a lot, but I guess it's still decent. I guess they still have quite a lot of firepower to give us in dividends and share buybacks. Like I said, 23 billion in 2018, and then they chilled out for a bit, and now it's accelerating again. I guess trailing 12 months, $8 billion. That's not too shabby. $8 billion compared to a market cap of 150 right now. That's not too bad. I like it. Let's see, common dividends. So as you can see here, they were paying 3.4 billion in 2018. They deployed a lot of money buying back shares, so they had to pay less in dividends because there were less shares outstanding. And they do pay the same amount in dollar amounts, but it doesn't mean that the yield went down here. The yield did not go down. It's just that they retracted a bunch of shares from the market, and in total, they had to pay less dividends. Market cap, let's just take a look here by quarter. I like to look at the evolution of the market cap. So yeah, hovering around 75, $80 billion for many years. Got a pump after 2020. and then crashed when the whole broader market crashed, and the semiconductor industry was doing quite bad in this period, mm, and has recovered since. And now I'm looking at it, and I'm saying that's not too bad to get into it right now. Yeah, sure, you're not going to be at a low of 124 like you could have got it a few years back in 2022. You're not going to have this opportunity anymore. So should you wait a little bit more? I don't think so. I think, yeah, from 156, if it goes down to 150 maybe, but it's not going to go down to 120. It's just not. They've been doing buyback since. The whole AI mania is going to prop up the share price. I mean, there are going to be buyers, even dividend investors are going to come and say, okay, they're going to announce rate cuts, and this is paying me 2.4% while growing the dividend and paying out in the payout ratio being 1/3 of their free cash flow, 33%. I mean, what's that? It's nothing. It's a very safe dividend. Let's just take a look at valuation. PE ratio 14. 10 years ago, 15, 16. You can see the cyclicality here. It did go down to about 10, which was completely ridiculous. I mean, there were a lot of other good opportunities too around this period. I mean, think of Facebook. It was trading at less than $90 per share, and now it's at 800 or so. So there were a lot of opportunities in 2022. Whenever the whole market goes down by more than 25%, I guess, you're going to find some incredible bargains. And the semiconductor industry as a whole was dirt cheap, was trading at a very low multiple, 10 P of 10 for a semiconductor stock. I mean, are you crazy? And now it's at 14. I don't know. I mean, I'm kind of getting mad. Why is this trading at 12? Forward PE 9 a few years ago. 12. I'm gonna add more. I'm getting mad over this valuation. I mean, Qualcomm is amazing. They just made their entry 1.5 years ago to the laptop market with their ARM chips, with the Qualcomm Snapdragon X or whatever it's called, and they are growing in a lot of other markets: AI, IoT, automotive. Yeah, EV to sales, not quite to all-time low. Let's say EV to EBITDA. A few years back, 2022 crash, 8.7. Now it's at 11.7. It's still dirt cheap compared to something like AMD. I'm going to show you AMD valuation in a second, but I mean, I think it's ridiculous to go for something like AMD instead of this, where you have very high risk with AMD. Return on capital invested 19% almost, at a very high level. Obviously, it's cyclical, but I like what I see. It's a very high number, and it's kind of sustainable. It's sustained. Yeah, there is an average here. I guess, I don't know, 17 would be the average over this period, maybe a little bit less. ROCE, again, trending up. I love to see this price being down, ROCE going up. As you can see, 2022 crash, it got to a high of 40, and then return on capital employed did go down because the whole fundamentals of the company were deteriorating, because that's the cyclicality of the semiconductor industry. But since then, it has been recovering. But take a look at the share price. It had another brutal swing last year, since June 2024. It dropped by 40% or so, while the fundamentals did not drop like it did in 2022. It's actually on the recovery pace. And it's trending up, so I like what I see. That's a good sign for me. FCF yield, more than 7%. Again, ridiculous valuation. You're getting a lot for your money, considering that the S&P 500 is less than 3%. And we're gonna take a look at AMD right in a moment. But yeah, it's almost at all-time high. It was trading at 8% in 2023. I like it right now. At the current level it's at, I think you're getting it at a very dirt cheap price. Let's take a look at AMD ratios here for AMD. Forward PE 32 compared to 12. So you do the math. What are you getting for your money? You know what I mean? The growth is not triple for AMD, and it's not the same. It's not the same as Qualcomm. It's not the same high quality company. It is a massive pump because of AI. People are hoping it becomes a competitor to NVIDIA. Maybe it will, maybe it won't. I just invest based on the numbers and not. I don't care about the story and the hopes. I do not invest on hopium. I don't really care what's capable of. I just look at the past and I take a look at the valuation and the share price and trying to make a logical decision whether or not I'm going to outperform the market in the upcoming years. So EV to EBITDA, we're looking at 51 times compared to 11. I mean, yeah, good luck with that. I don't know how to say it. Return on capital employed, very low number. It did have a high, which is less than what Qualcomm had back then, but it did not recover. It's still in the toilet, 2%. What's that? I mean, last year, 2%, 2022, 2%. I mean, yeah, it did not recover. ROCE, I think it's 44% was a bit higher than Qualcomm, but yeah, again, it did not recover. Should have been at least 17 or more. Yeah, it's very slow to recover, and I don't see, this is not a good sign. I mean, I see fundamentals being in the toilet. FCF field, they do not pay any dividend, and the buybacks are very small. And we're going to take a look at share-based compensation for AMD and compare it to net income as well. But yeah, 2022 crash, it was trading at 3%. I guess this was a very nice time to buy it. And then right now, 1.4%, a terrible deal. Very extreme, no margin of safety at all. Actually, this is a very high risk. I would not like to hold this in my portfolio right now. Actually, it just went down by 10% or more last few days. I mean, the market is open right now and it's down 6%. So yeah, like I was saying, net income trailing 12 months, 2.8 billion. Let's just take a look at stock-based compensation. 1.4 billion of that net income is going to stock-based comp. So yeah, there's not a lot of free cash flow left for repurchases of common stock. They are doing 2.3 billion compared to the almost 9 billion of Qualcomm. And keep in mind, Qualcomm is at a market cap of 158. Did I get it right? Or to 156, and then AMD is right now at 265. So it does not have the same kind of impact. If I was in the management of AMD, I would say, yeah, let's just repurchase the common stock to the same amount that we do stock-based compensation, and then maybe save up cash for something else, maybe some other type of acquisition, maybe growing our cash piles to do something else with the cash, not just pouring money into buybacks when the valuation is so bad. Makes no sense. This will bite them in the ass. This will come back and bite them in the ass. Make no mistake. They need this money. The AMD does not have the same level of margins as Qualcomm. It keeps eating Intel market share from a lot of different segments, but that's going to stop at some point. And yeah, I mean, look at this operating margin, 1% 2023, 8% last year, trailing to 8. And this is bad. Just use that cash to improve your margin somehow. But yeah, anyway, the growth in the stock will slow down at some point, and the market cap is going to crash, unless they do become a strong competitor to Nvidia. Maybe the stock price goes up by, I don't know, 5 times. But yeah, that's just not how I invest. I don't invest on luck. I don't gamble. I don't say, oh, maybe this could happen, or maybe this, or maybe that. I generally tend to stay away from trending stuff and high valuation stuff and what's popular. I am a contrarian investor. I invest in unpopular stuff that's going down, falling knives, such as Novo Nordisk. Novo Nordisk is down today again. I mean, look at this. This is what I like to invest in, minus 67%. UNH, another falling knife. This is what I want to invest in. Very unpopular stuff in the short term. And then I make money when it recovers. So $247. Let's just take that level. We cannot even find it because it's too gone. I mean, we can find it here. Let's just say we bought it at 252. We can make more than 100% of our money if the stock price recovers So we double our money, we double our investment while getting paid a fat dividend of more than 3% to wait for that to happen. So that's a very good deal in my opinion. And we're not investing into some very low quality company. We are investing into the leader, like I talked about in the last. These are leaders, UNH, NVO. When we compare it to the competitors, to the competition in that segment, they are the highest quality company and the leader. So yeah, it's not like you invest in some, I don't know, opium stuff or something that was a bubble and crashed. No, this was a very high quality company that was valued decently, and now it's dirt cheap. And eventually it's going to recover, okay? It's not going to go bankrupt. They have no problems with debt or anything like that. But yeah, Qualcomm is not crashing hard right now. It was before. It was a better opportunity before, but even now it's looking very good. If you have the stock right now in your portfolio, I would definitely not sell. For me, Qualcomm is gonna be part of my portfolio for a very, very long time. Several years, at least 5 years. It's just gonna stay there in the top. You know, I'm getting paid dividends. I like it. Same as PepsiCo. With PepsiCo, I have a higher allocation here, and I will be taking profits as I make gains on the share price. But yeah, a lot of defensive stuff. Why? Because S&P is at all-time high. My strategy is to be less aggressive right now, more defensive, lower valuation, higher margin of safety, dividend-paying companies, companies that are able to do buybacks, companies that are responsible with their share-based compensation and they don't go crazy. Stuff like that you're going to see in my portfolio. PepsiCo, Alibaba, Novo Nordisk, Qualcomm, Qualys, ASML, Paycom, United Health, and a bunch of others that I haven't made a video about. I'm gonna make video about any of this pretty soon. But yeah, that was about all I had to say about Qualcomm. Keep comparing your investments whether you want to invest into Qualcomm or AMD. Just go here. I recommend you to go to stock analysis and you can click here on industry. But keep in mind here, there are a bunch of different types of semiconductor stocks. TSMC, for example, Taiwan Semiconductor is a pure fab. They only manufacture chips for other designers. AMD is a fabless designer. Texas Instruments is a integrated device manufacturer, so IDM. Qualcomm is a fabless. ARM is a software licensing type of software. Look at this, gross margins 97%. Micron is involved with chip making and memory making. So yeah, be careful what you compare it to. AMD is Qualcomm is to be compared to AMD, Broadcom, I guess, Nvidia, Marvell, NXPI, monolithic power systems. But yeah, I mean, that's your job, to spend a lot of time getting to know the industry, getting to know the sector, getting to know every single company in here. I could tell you all of the margins and all of the valuations for each of these stocks in particular. Why? Because they are all part of my investable universe. Let me pull out here my investable universe document here. So this is what I have here. Technology, semiconductors, foundries, pure play, semiconductor equipment. This is everything that I'm interested in. And I just click here on something I like just to check out their price. Something like KLA Corporation. Let's see what's it trading at. And it's bringing me to stock analysis page. And I can quickly take a look. Okay, it's very close to all-time highs. I'm not going to touch it right now. And then I go from here on to innovation. This was very interesting for a while. And it's still down in the toilet. I'm still deciding whether or not I should buy it. All of the other semiconductor stocks have recovered except this one. There are a lot of aspects to take into consideration. But anyway, invest a lot of time. Don't just look at some videos and say, oh yeah, I've made up my mind. I'm going to buy Qualcomm because I like how it sounds. How, I don't know, I like how they're naming their chips Snapdragon. So that's nonsense. That's stupid, okay? Try to understand the industry. Try to understand the overlapping competition. Who is competing against who? Who's going to come on top? Who's the high margin player? Who's the top dog? What's it trading at? What is the cheap? I mean, look at this. OLED. Look at the margins here. Gross margin 75. Operating margin 37. Net revenue growth last 5 years 8%. annualized net income 10%. This is a great looking stock. Let's just take a look. What's it trading at right now? 6 billion. Okay, there are a lot of opportunities. Look at the stock price. Zigzag, zigzag, zigzag. It's not at a bottom, but it's not. It's very far from the top as well. 140, and it was trading at a high of 250 a few years ago. Is paying a dividend of 1%. Like I said, there are a lot of opportunities. You just have to look for them. You have to know each stock. What's it about? What are they doing? What are the future prospects of growth and stuff like that? What's the cyclicality? I mean, you take a look at something like Micron. Okay, Micron has huge swings. I made 70% on a trade because I bought it pretty much at the low, and I sold it when it spiked up by a lot. So why? Because I know I have been involved with the stock for many years, buying and selling it, and I know how it performs, how it reacts, how the market is trading it. So whenever it goes down by a lot, I buy it. Yeah, IDMs, integrated circuit design software. ANSYS from here I must delete it because it was bought by Synopsys. But yeah, Cadence Design Systems, ARM, Autodesk, Synopsys, Bentley Systems Incorporated. This one is interesting. Mobileye, Path, UiPath. But yeah, anyway, just wanted to show you very quick this document that I have here. I put all the numbers so that I can compare looking at them visually. Okay, I look at Qualcomm, I look at the gross margins. All of the numbers are color coded based on comparisons to the S&P 500. So dark green here is a lot better than what the S&P 500 is on average. But I can also compare to each other. So AMD here, the margins are not looking, they're very weak, okay? They might become better in the future, but once they become very good looking, the growth might have been slowed down by a lot and the share price could have gone into the toilet. Right now it's growing. Revenue last 5 years annualized 30%. Net income growth 5 years 35% compared to Qualcomm of 11 revenue growth and 22% net income growth. So should you pay 3 times more, 5 times more for AMD than you can right now for Qualcomm? I would say definitely not. Qualcomm is paying me a dividend who hold them. They have a lot of cash, a lot more cash potential to buy back shares and make some other type of acquisition, buy talent, employ people. I don't know. They have a lot more potential. Yes, they're not so hot right now, and they're not trending so high because they don't have AI chips, but they might also be very relevant in the future with AI on handheld devices and laptops and stuff like that. But anyway, that's for you to do your own analysis, do your own due diligence, and get to work. You're not going to make money just watching videos passively, just looking at random YouTubers. I would say you should start reading books. You should listen to the great investors and make your strategy based on how other great investors have made money consistently in the stock market. Warren Buffett, Charlie Munger, Seth Klarman, Peter Lynch, Howard Marks. There are a lot of people you can listen to. You don't have to go on YouTube and say, oh yeah, some Amit Koreja guy keeps talking about Palantir, and it seems that Palantir is going up by a lot, so he must be right. The guy has no idea what he's talking about. He has not made money in the stock market. He has not outperformed the stock market. He just made videos a couple of years ago, and the stock blew up. He made videos about a lot of other things. But yeah, anyway, it's your job to go get to work and use your own logic and your own philosophy when you're trying to outperform the market. Don't just get hyped. Don't follow trends. Have your own strategy and stick to it.